Welcome to the Q1 2026 Wespath Investments webinar. My name is Joe Halwax, Senior Managing Director here at Wespath, joined by my colleague and University of Illinois alum, Karen Manczko. What can we say? The world looks very different than it did when we last joined you 3 months ago, obviously owing to the Feb 28 bombing of Iran. What we're seeing is a real structural shift in geopolitics, in energy delivery, and also in asset prices. And it's shifting the way that we're looking and managing risk. So today, we're going to evaluate what happened up until Feb 28th, and then take a look at what's happened since the invasion of Iran. We're going to take a look at Wespath funds and your performance of your portfolios, a look at some of the new changes in the Wespath funds, and then we're going to wrap it up with a look at 3 scenarios for oil. But first, a quick nod to our alma mater and Final Four team, University of Illinois.
Well, I love bringing in University of Illinois into anything that we do. And so I think a really good analogy is, how it relates to the current market environment and the recent loss that University of Illinois had in the Final Four to UConn. I think when I think about the University of Illinois basketball team, they played well, they had really strong fundamentals, a great bench of players, but UConn just really kind of represented a period of overwhelming forces against University of Illinois. They have the depth of the bench, the momentum. When you think back, UConn was the national champions in 2023 and 2024, so they kind of had that momentum going into the Final Four, which just simply changes the conditions of the game. So right now, markets feel a little bit similar to that game. Illinois representing good companies, strong strategies, strong earnings reports, reasonable balance sheets, really good long-term growth prospects, but they're just up against a dominant opponent, UConn. Think about UConn as being the higher interest rates for longer, tighter financial conditions, elevated volatility and uncertainty. So really macro forces that can overwhelm fundamentals in the short term.
So when I'm paying $5 for gas, I'm going to be thinking about UConn as my nemesis.
Yes.
So, all right, so Karen, I mentioned that we were looking at the quarter, and it obviously changed dramatically in March. So let's look at the quarter as we got up until February 28th, under the context that knowing after Feb 28th and things changed, things tend to revert back to where we were before the shock.
Yeah. So if we think about the markets prior to that February 28th invasion, the start of 2026 was fairly constructive for the markets. Economic growth, as we reported in the last quarterly update, economic growth was slowing, but it was still positive. Inflation had come down from its prior peak. So I think everyone was watching, investors were watching, and become increasingly more focused on how central banks will begin to ease. Corporate earnings were holding up well. We saw some positive market returns. Oil prices were stable, and I even would argue in some areas pretty cheap. So the risk appetite was really a little bit cautious, but functional. So in short, really, the markets were in this more late cycle but orderly environment, cautious but not stressed. I think we were more concerned, like I said, with rates and valuations over really geopolitical risk. But really, if we look at this chart here, that's going to be on the screen, is a really good chart to show. So on the left, you see the price of oil. And you see that sharp spike from when it was near $60 pre-invasion to roughly $110 a barrel 5 weeks later. And on the right, you see the five calendar years, and it tracks the price of retail gasoline. The orange line goes vertical, similar to what we saw in 2022, and that represents 2026.
Yeah, it's kind of a scary chart here. And I'm thinking of fellow alumni, Rich Excel on the CFA podcast recently was talking about after Feb 28th, when you have crisis and shock, all correlations go to 1, or in this case, -1. So the podcast really talked about how since Feb 28th, you see if there's a talk of a ceasefire, you see oil go down, equity prices rally. And then when there's an escalation in say the rhetoric or the physical bombing, then you see oil prices spike and equity prices come down. So the correlations right now are running quite high, which if 20% of oil is flowing through one narrow place, that seems to make a lot of sense. But then let's think about then going back to like after Feb 28th and
Yeah.
what we've seen since then.
Yeah, so it really became this risk-off regime or risk-off environment. So the immediate aftermath of the bombing was oil and energy prices surge, which can be expected because investors were pricing in a potential disruption to that supply. And then obviously there's heightened geopolitical risk as well. So we saw that energy shock really kind of flow through to the markets. I think the name of what we're going to really be talking about is oil, inflation, and interest rates. And you're going to see those three things kind of pop up throughout the rest of the webinar. So again, it kind of reignited those inflation concerns, prompting repricing of interest rate expectations. So as a result, we saw equity markets sell off globally. It really put most of the pressure on those mega cap names, those growth names. They were already trading at pretty elevated levels, so they're a little bit more sensitive to the news, I would say. International markets pulled back. Probably recall from the last webinar or our 2025 update is that internationals finished 2025 pretty strongly, re-entered into 2026 strong as well. So we did see some pullback, and part of that was driven, we did see the dollar surge in the month of March. Bond markets also weakened, so it wasn't nearly just an equity story. It was also a fixed income bond story as well. Obviously, that's because of concerns with inflation, which pushed yields higher, particularly on the long end. But the good news is commodities outperformed, primarily led by energy, and we'll talk a little bit more about that in a moment.
Yeah, I think I saw today before we walked in, oil's actually at 116, so we've gone from 110 at the end of the month, even higher in the last 7 days. Thinking about when we started the year, we looked at the 6 major themes that we talked about as an investment committee that we want to talk about with clients. And obviously, number 2 is in the driver's seat for now, and it's going to probably stay there for the next 4 to 8 weeks. But Karen, what about AI? We were still concerned about that, or it was the theme, and now where are we at?
I mean, AI continues to be a compelling long-term theme. Noted that there was some elevated valuations and also the concentration of AI names in the market, which really makes it sensitive to and vulnerable to really rapid shifts in sentiment to the asset class or the types of stock. And we did see that throughout the quarter was risk resurfaced, because there was a poorly received earnings report from Microsoft. So we saw a pretty big loss in that company's stock that we hadn't seen in years, just again, kind of being triggered from this poorly received earnings report from this company. So again, AI continues to evolve at a rapid pace. It's going to be a clear theme for the near term and even the long term, and definitely capturing the attention of investors at this time, and for some time it will.
Yeah, and software really got hit. When you think about software, their numbers are still great. They're cutting workers like the likes of Oracle,
Yeah.
but they're maintaining margins. But now, if you can get into cloud code and vibe code away from some software that you're used to paying for, it's hard to know what that company's now worth in 10 years. So it's going to be a tricky time as the disruption comes from AI. Thinking back to number 2 with geopolitics, I want to mention that our CIO, Jahar Farhadieh, has a segment with Thomas Mucha, and they go pretty deep on the geopolitical side, and they start talking about the megatrend shift into a more bipolar world that we've been seeing for some time, the reshoring of supply chains, and they go pretty deep on that and the long-term effects of this. So we encourage everyone to watch that segment. And then as addition note, a couple other things on here. When you think about private markets down on bullet 6, there's a lot of talk about private credit. And what we would say about private credit is if we get into the worst case oil scenario, if we get into really longer term economic weakness, that could be the trigger for, say, some for that to see more defaults in the private credit space. And then I think, and when you think about rates and central banks too, the Fed has a dual mandate, so the Fed might not have to raise rates as high as other central banks in that worst case scenario, which obviously we hope doesn't happen. But we'll keep watching these 6 major themes that keep driving markets this year. Let's now switch gears, and let's switch to a look at the market impact. So we had a negative quarter for the first time since Q1 of 2025, which was leading up to Liberation Day. This is the worst quarter we've had since 2022. And we just went through 5 straight weeks, 5 negative weeks, which is the first time we've done that in a while until last week was positive. So looking at this slide, Karen, what What can you say about it?
Yeah, so this slide shows the performance for the quarter organized best to worst asset class for this time period. So what really stands out immediately, Joe, and like you mentioned earlier, is that we did see some more negative returns across the asset classes than we'd seen in previous quarters that we've reported on, which really reflect a clear market shift. I'm going to start with international equities. So as I mentioned, international equities entered 2026 on solid footing, particularly emerging markets. You can see emerging markets on the slide down a little less than a quarter of a basis point. Again, this wasn't driven by weak fundamentals or weakening fundamentals. It was purely based on the rising uncertainty that's tied to these geopolitical developments, especially in the Middle East. Also, we saw energy prices spike, begin to reprice inflation and growth risk globally, which also weighed on international equities more so. So if we kind of shift our eyes down the slide, looking at U.S. equities, the S&P 500 posted a loss of 4.33% for the quarter. Again, this wasn't an earnings collapse story. Corporate fundamentals strongly held up or positive. Instead, it was really a valuation and repricing story driven by oil prices and, again, that renewed inflation concern that we kept hearing about. The worst performing asset class was mega cap stocks. You can see down at the bottom, down 11.64%. These companies entered the year really at elevated valuations, which I would say would be more like a crowded positioning, making them really sensitive to shifts in the marketplace or any sort of news like inflation or interest rate concerns again. But at this time, and we're going to shift our eyes back up on the slide. If we think about, there was a rotation into small cap stocks. So you can see small cap companies were in positive, returning 89 basis points, which was the leader for the equity markets for the quarter. I will say that timing does matter. Markets, the performance of the markets changed meaningfully throughout the quarter, as we mentioned, kind of that February 28th date, when there was tensions were escalating with Iran. We saw that spike in oil, which was really the catalyst for increasing volatility, altering those inflation expectations, and really driving this sort of risk-off sentiment from investors, which pulled the equity markets into negative territory across the board.
Yeah, I think the rotation theme you had is certainly one we've been seeing since last fall, continuing into the quarter. Really, March was the kind of disruption to that. Thinking about the peak, when you look at the ACWI and the EM and S&P 5, I believe they peaked around Feb 14, 16, and 20. So the more sensitive areas to energy, which Europe and Asia are more sensitive, emerging markets are more sensitive, say, than the U.S. because we're a net exporter, seemed to roll over first, and they were hit the most in March, more so than the U.S. Let's move on, though, from equities. We'll talk more about our equity funds in a second, and let's look at fixed income. When I think of a major conflict like this, and you see things like the dollar rallying and flight to safety, we wouldn't normally think of treasury of yield curves moving higher. Yep. So let's talk about fixed income.
Yeah, so we can't talk about fixed income without talking about the yield curve. So you'll notice on this chart that's on the screen is that on the short end, so you see the blue line represents March of last year, March of 2025. The gray line represents March of this year, so more recently. So you're going to notice on the short end, we did see yields drop on that short end. But if we kind of glaze our eyes over to the right, you'll notice that yields rose on the long end, which really is reflected in that fixed income market return. Just as a reminder to our listeners, our viewers, is as rates rise, the price of your bonds go down. So as we saw on that far end, the rates go up, it did negatively impact the fixed income market, which you'll see on that next slide. The U.S. aggregate index was roughly flat for the quarter, but it is important to note that it lost 1.7% in the month of March alone. So a lot of this driver of the fixed income returns that we see was purely based on what we saw in the month of March.
Yeah, it really looks like in the short end, the 2-year, you saw a rise of 48 basis points in the quarter, about 40 in the 10-year. Any thoughts on that? Is it purely just inflation expectations that's driving yields higher?
Yeah, so as I mentioned, bonds struggled in the first quarter because of rising oil prices, which fueled this inflation concerns, pushing those yields higher, which is forcing a repricing of interest rates expectations. We also saw the U.S. dollar rally in the month of March, as I mentioned, which adversely affected those non-dollar bond allocations. You'll see the Bloomberg Global Ag Index at the bottom, returning negative 1.07%. So while bonds play an important role in portfolios, really the quarter served as a good reminder that fixed income is still vulnerable when inflation risks reemerge and when rates move higher. So always something we need to be cognizant of. But one final note, Joe, before I'm going to turn it back over to you, is that if we look at this chart, is that commodities were the best performing asset classes. And we kind of highlighted this in our opening remarks. Commodities were up 24%, which was obviously one of the best performing asset classes across the board between bonds and equities. Again, this was primarily driven by those sudden geopolitical risk or events that were happening with the supply shock and supply chain shock, and really those inflation dynamics with investors positioning. This is a positive for our investors that are particularly invested in our inflation protection fund, as we have a 10% allocation to commodities. But I'll touch a little bit more on that later.
Yeah, when you think about, as we're getting ready for this, you can think about 20% of the world's oil that passes through the Strait of Hormuz, but then other things like chemicals, like helium, fertilizer, things like that. And so when we think about that, the oil goes from 67 to 100 in 30 days. And energy prices, they move, it acts like a tax. It's a tax on food, transportation, on manufacturing, on supply chains. And so it makes sense that we've seen this kind of negative reaction globally. But then if I can give some hope to this to this segment, historically, when you look at oil shocks specifically, they don't tend to have a long-term impact on asset prices, which is why we asked you about how things were before this oil shock. And if you look at the year after an oil shock, the returns are roughly 8% for equities, which is the same historically as they are in every other calendar year. So what we're hoping, obviously, is that this holds true with this time as well, and hopefully that this is also shorter lived. All right, moving on to Wespath fund performance. Karen, I'll cover equities if you can cover fixed income. And looking at the top of our active U.S. equity fund, it was up about 1% versus benchmark, still down on the quarter, given what we saw particularly in March, but outperforming. We had 3 of our 5 active managers beat their benchmark. We are still slightly underweight mega caps, which certainly helped, given what you mentioned about mega caps earlier. In stock selection, contributions were in industrials, IT, and consumer discretionary. On the international side, we were slightly lower than the benchmark, right about at benchmark before fees, and so we slightly underperformed. We're underweight to value and underweight slightly to energy, and obviously energy, which you just mentioned, was the biggest performer, particularly in March. We had 2 of our active managers were above the benchmark, 2 slightly below, and 2 were right on it. I also want to highlight on the slide that we have our 3 index strategies. We have the U.S. Equity Index, International Equity Index, and Social Value Choice Equity Index. Reminder, Social Value Choice is a blend of U.S. and international stocks. And then, Karen, what do we want to say about some of our new managers?
Yeah, just kind of briefly as a reminder to our listeners and our viewers is that we did have some manager changes within the U.S. Equity Fund. We highlighted these in the last quarterly webinar, but just as a reminder, wanted to show them to you all as we did highlight the performance of our U.S. Equity Fund.
Yeah, and I think as we look at here, we're looking at a real balance of risk and more resilient stock selection and set up for a more higher dispersion market.
Exactly.
And then fixed income. How did Wespath perform in fixed income?
Yeah, so looking at our fixed income funds on this slide, right at the top, you see the fixed income strategy. A reminder, this is a 100% active fixed income product at Wespath. We did lag during the quarter. Primarily, this was any sort of diversifying strategy outside of U.S. Treasuries was a detractor to the performance. Also, the fund does have an allocation to emerging market debt. And as I mentioned, a lot of those non-dollar allocations was a detractor as we saw the U.S. dollar rally in the month of March. Also, some of those duration-sensitive sectors within the fixed income market also were a detractor as we saw rates rise on that long end, obviously having an impact to those types of strategies. But despite that underperformance that we had for the quarter, if you look at the farther time periods, historic, you'll notice that the fixed income fund has outperformed its benchmark across all time periods historically. The last one I'll highlight is the Inflation Protection Fund. This fund outperformed its benchmark modestly, primarily driven by global inflation-linked bonds. Obviously, that commodities exposure that I highlighted earlier, as commodities were one of the best performing asset classes for the quarter. Again, this fund did well, driven by inflation concerns, that energy shock dynamic as well, all kind of bolstered the performance of this portfolio.
All right, so Karen, so we're going to wrap it up now. We mentioned we're going to bring 3 scenarios for potential for oil prices. And I do want to mention we're filming on April 7th. Today is the ultimatum day, so I hope that this is still relevant when people watch this. But there's 3 scenarios. Let me do the worst, the best and the worst, and maybe you do the base case. So we can start with the most constructive outcome. Constructive outcome, hopefully, is that something is resolved relatively soon. You would see oil retreat from its $115 to probably back near $80, $85. Doubtful we'll get back down to 60, given the amount of volatility that we've had and the disruption and concerns about future supply. We would have to think that puts the inflation expectations much lower and possibility for a Fed rate cut at some point in the future. And you'd have to think asset prices would rally.
Yeah, really that. And if you think about the central case kind of in the middle, is that disruptions persist April into May. Oil averages about $95 to $100 per barrel. We see that CPI in April number get reported above 3%, with all of that energy kind of pass through and sort of driving that increase in that CPI, which makes the Fed kind of hold steady through May and June, which would be that September would be really the earliest easing window that we may see from the Federal Reserve. Markets remain a little bit volatile. Commodities, energy, and TIP outperform. And then we do see, obviously, the impact of the yield curve, which makes those duration-sensitive strategies lag a little bit.
Yeah, and I think to wrap it up on the downside, we mentioned it already, but in a protracted scenario, again, seeing oil that could go even higher. As we were preparing for this, we saw that the recent spikes in 08 and in 22 have been above 120, but we've never really seen oil sustainably above 100, 124 weeks, months at a time. Obviously, we would have to think that would point us much more towards recession. Other countries probably have to look at raising rates in the face of inflation. It's a scenario that we just hope doesn't occur, but that would be the worst case.
Yeah, we'll definitely keep a close eye on the markets and make sure that we keep our investors updated on how things progress, particularly as the geopolitical events unravel. For those of you that aren't signed up to receive our weekly market update, go on our website, sign up to receive that. This is, the easiest way for us to send out information so that you all feel informed about what's going on. So I think to wrap up, it's, bring it back to Illinois and UConn basketball game. As I mentioned, the markets right now feel a little bit like Illinois running into UConn in the NCAA tournament, that Final Four game. Illinois didn't do anything wrong, but definitely the markets favored a dominant opponent. So in the markets, strong fundamentals can still struggle with macro forces that kind of overwhelm that matchup that we have, which is why really having that disciplined approach, remaining patient, matters more than being reactive, especially when it comes to your portfolio.
So we want to thank you for joining us today. We want to thank you for your partnership. Thank you for trusting Wespath to steward your assets and helping us support your mission. If you have any questions about anything we talked about today, obviously the markets are very fluid, very dynamic. Please send a note to your Wespath representative. We look forward to seeing you all at quarterly meetings in April, and thank you again for joining.